Dividend stocks and growth stocks represent two fundamentally distinct philosophies of equity investing, each appealing to different investor profiles based on financial goals, time horizons, and risk tolerance. Dividend stocks are typically issued by mature, stable companies that generate consistent cash flow and choose to distribute a portion of those earnings directly to shareholders in the form of regular cash payments. These companies often operate in established industries, utilities, consumer staples, telecommunications, where explosive expansion is unlikely, but operational reliability is high. In contrast, growth stocks belong to companies that reinvest nearly all their profits back into the business to fuel expansion, innovation, or market capture. These firms usually operate in dynamic sectors like technology, biotech, or renewable energy, where future earnings potential is prioritized over current income. The critical misunderstanding most investors have is assuming one category is inherently better than the other. In reality, both serve unique purposes within a diversified portfolio. What truly separates these two asset classes is not performance, but cash flow allocation strategy. A dividend stock signals management's belief that the company has limited high-return internal investment opportunities, so returning capital to shareholders becomes the most efficient use of profits. Growth stocks, however, reflect a management team convinced that every dollar retained can generate outsized future returns, whether through research and development, acquisitions, or scaling operations. This distinction is not about quality or potential, but about stage of corporate lifecycle and capital deployment priorities. Investors who chase dividend yields without analyzing payout sustainability often overlook the risk of value erosion. A company paying high dividends while shrinking its business is not a safe investment. It's a slow liquidation. Conversely, investors who blindly chase growth without evaluating capital efficiency may end up holding overvalued assets with no path to profitability. The market often misprices both categories due to emotional biases. Dividend stocks are wrongly labeled safe simply because they pay cash, ignoring that many are vulnerable to disruption, regulation, or declining industries. Growth stocks are often labeled risky because they don't pay dividends, ignoring that many are building dominant market positions with scalable economics. The truth is, risk isn't defined by dividend policy, it's defined by business model durability, competitive advantage, balance sheet strength, and valuation. A telecom company paying a 6% dividend while losing subscribers to fiber and wireless alternatives is far riskier than a software-as-a-service company growing 30% annually with 80% gross margins and no dividend. Yet, many retail investors will choose the former because it pays them to wait, not realizing they're being paid to lose principal. Another layer of confusion comes from conflating total return with income. Many investors believe dividend stocks make money while they hold them, whereas growth stocks only make money when sold. This is a dangerous fallacy. Total return, the combination of price appreciation and dividends, is what matters. A stock that pays a 4% dividend but declines 6% in price has a negative 2% total return. A growth stock that pays no dividend but appreciates 15% delivers a 15% return. The dividend is not extra money. It's a redistribution of company value from the stock price to your bank account. When a company pays a dividend, its stock price typically drops by the amount of the dividend on the ex-dividend date. You're not gaining wealth, you're receiving a portion of your existing ownership value in cash. This mechanical reality is ignored by most dividend-focused investors. Tax treatment also plays a crucial role in long-term performance that's rarely discussed. In many jurisdictions, qualified dividends are taxed at lower rates than ordinary income, which sounds favorable, until you compare it to the tax deferral advantage of growth stocks. With growth stocks, you pay zero taxes until you sell. That means your entire return compounds tax-free for years or decades. With dividend stocks, you pay taxes every year on the income received, even if you reinvest it. Over 20 years, that annual tax drag can significantly reduce your net return, especially in higher tax brackets. This doesn't make dividend stocks bad, but it does mean their pre-tax yield must be substantially higher to compensate for the tax inefficiency, a calculation most investors never perform. Behavioral psychology further distorts investor perception. Humans are wired to prefer immediate, tangible rewards. A quarterly check feels like real return, while unrealized paper gains feel abstract. This leads to emotional overattachment to dividend stocks, even when fundamentals deteriorate. Investors will hold onto a declining utility stock because, at least I'm getting my dividend, ignoring that the capital loss outweighs the income. Meanwhile, they'll panic sell a volatile growth stock after a 20% dip, not realizing that short-term volatility is normal in high-growth businesses. The psychological comfort of dividends can become a trap. It masks underlying risk and discourages objective reassessment of holdings. True investing requires evaluating assets based on future cash flows, not current income rituals. Valuation metrics commonly used to compare these stocks are often misleading. Investors praise dividend stocks for having low price-to-earnings ratios, but that's frequently because earnings are stagnant or declining. A low price-to-earnings on a dying business isn't a bargain, it's a value trap. Growth stocks are criticized for high price-to-earnings, but if earnings are growing 30% per year, today's high multiple may be justified by tomorrow's expanded profit base. The key is not the static multiple, but the trajectory of earnings and the sustainability of growth. A better metric for dividend stocks is the payout ratio. If a company pays out 90% of earnings as dividends, it has little room to reinvest or withstand downturns. For growth stocks, focus on revenue growth, gross margins, free cash flow conversion, and customer acquisition economics, not whether they pay a dividend. Market cycles also affect the relative performance of these categories in ways most investors fail to anticipate. In low growth, high inflation, or rising rate environments, dividend stocks often outperform because their cash flows provide a hedge against uncertainty. But in innovation-driven, low-rate, high-liquidity environments, growth stocks dominate because future earnings are discounted at lower rates, making long-term cash flows more valuable today. The mistake is assuming past outperformance will continue indefinitely. The 2010s favored growth. The 2022 bear market punished it. The late 2010s favored dividends. The 2013 to 2021 tech boom crushed them. Rotation is normal. Successful investors don't pick sides. They understand regime shifts and allocate accordingly. Finally, the biggest myth is that you must choose between dividends and growth. In reality, the most intelligent portfolios combine both, using dividend stocks for stability, income, and lower volatility, and growth stocks for capital appreciation and inflation-beating returns. The optimal mix depends on your age, goals, tax situation, and risk capacity. A 65-year-old retiree may need 60% in dividend payers to fund living expenses. A 30-year-old with a 30-year horizon may allocate 80% to growth to maximize compounding. Neither is wrong. What's wrong is dogma, the belief that one philosophy is morally or financially superior. The market doesn't care about your preference. It cares about cash flows, valuations, and fundamentals. Align your portfolio with reality, not ideology. To summarize this first session, dividend stocks and growth stocks are tools, not ideologies. One returns capital via cash distributions, the other via price appreciation fueled by reinvestment. Neither is inherently safer, better, or more profitable. Their effectiveness depends entirely on context. Company fundamentals, economic environment, valuation, and investor objectives. The truth most investors don't know is that the dividend itself is not the source of return. It's the underlying business performance. A great company that doesn't pay dividends can build more wealth than a mediocre company that does. Focus on the engine, not the exhaust. The mechanics of dividend stock returns are widely misunderstood, even by experienced investors. At surface level, it appears simple. You buy a stock, it pays you cash every quarter, and that cash represents income or yield. But beneath this apparent simplicity lies a complex interplay of corporate finance, market pricing, and total return dynamics that most investors ignore. The first critical point to grasp is that dividends are not free money. They are a transfer of value from the company's retained earnings to shareholders, which immediately reduces the company's book value and, in efficient markets, its stock price. On the ex-dividend date, the stock price typically drops by the exact amount of the dividend. If you receive $1 per share, the stock opens $1 lower. You haven't gained wealth, you've converted a portion of your equity stake into cash. This mechanical adjustment reveals a deeper truth. Dividend returns are not additive to price appreciation. They are substitutive. The total return of a dividend stock is the sum of price change plus dividends received. If the stock price falls by more than the dividend amount, your total return is negative. Many investors in high-yield sectors like energy, real estate, or telecom have experienced this painfully, collecting 6 to 8% yields while watching their principal erode by 10 to 15% annually. The dividend didn't protect them, it masked the underlying value destruction. A sustainable dividend must be supported by growing or stable earnings and cash flow. If the business is shrinking, the dividend is a withdrawal from capital, not income. This is why payout ratio, dividends as a percentage of earnings or free cash flow, is the single most important metric for dividend investors. Another misconception is that dividend stocks are less volatile. While it's true that mature, cash-generative businesses tend to exhibit lower beta than high-growth tech firms, this doesn't equate to lower risk. Volatility measures price swings, not fundamental risk. A regulated utility may have low daily volatility, but carries enormous regulatory, environmental, and technological disruption risk. A pipeline company may pay a 7% dividend but face existential threats from environmental, social, and governance pressures or energy transition. Low volatility can create a false sense of security. True risk is the permanent loss of capital, and dividend stocks are not immune. In fact, they can be more vulnerable during structural industry shifts because their capital allocation model leaves little room for reinvestment or transformation. Once disruption hits, they often lack the resources to pivot. The sustainability of dividends also hinges on cash flow quality. Many investors look only at earnings per share and dividend per share, ignoring the difference between accounting profits and actual cash generation. A company can report strong net income while bleeding cash due to working capital demands, capital expenditures, or debt service. Free cash flow, operating cash flow minus capital expenditures, is the true source of dividend capacity. If free cash flow covers the dividend with a comfortable margin, the payout is likely sustainable. If the company is borrowing or issuing shares to fund dividends, it's a red flag. This is common in real estate investment trusts, master limited partnerships, and some telecoms, sectors where investors chase yield without scrutinizing the cash flow statement. Yield is only attractive if it's self-funded. Dividend growth is another critical but overlooked factor. A static dividend in an inflationary environment is a declining real return. The best dividend stocks don't just pay, they grow their payouts consistently over time. Companies with long records of annual dividend increases, dividend aristocrats or dividend kings, tend to be those with durable competitive advantages, pricing power, and efficient capital allocation. These are the true compounding machines within the dividend universe. A 3% yield that grows 7% annually will outperform a 5% static yield within a decade, even before considering stock price appreciation. Yet most investors fixate on headline yield, ignoring growth trajectory. This is like choosing a job based on starting salary without considering career advancement potential. Reinvestment risk is rarely discussed in dividend circles. When you receive a dividend, you now hold cash that must be redeployed. If markets are expensive, you may be forced to buy overvalued assets or sit in low-yield cash, reducing your overall return. Growth investors avoid this problem. Their returns compound automatically within the stock, without triggering taxable events or reinvestment decisions. Dividend reinvestment plans mitigate this somewhat, but they still occur at market prices, which may be unfavorable. In a bear market, reinvesting dividends can be advantageous. You buy more shares at lower prices. In a bubble, it can be destructive. The timing risk is real and often ignored by passive dividend collectors. Sector concentration is another hidden danger. Dividend stocks are heavily concentrated in a few industries: financials, utilities, energy, consumer staples, and real estate. This creates unintended portfolio biases. If you build a portfolio chasing yield, you may end up overexposed to interest rate-sensitive sectors, utilities, real estate investment trusts, or commodity-driven sectors, energy, materials, without realizing it. This lack of diversification increases systemic risk. A rate hike cycle can crush your utility holdings. An oil price collapse can devastate your energy dividends. A retail apocalypse can sink your consumer staples. Diversification isn't just about the number of stocks. It's about exposure to different economic drivers. Dividend-focused portfolios often fail this test. Management incentives also play a role rarely considered. When executives are evaluated or compensated based on dividend consistency, they may prioritize maintaining the payout over making necessary investments or balance sheet repairs. This can lead to underinvestment in innovation, deferred maintenance, or excessive leverage, all of which undermine long-term value. Conversely, some managements use dividends as a signaling tool to attract income investors. Even when the payout isn't sustainable, the market often rewards this short-termism until it doesn't. When the dividend is finally cut, the stock typically crashes, and income investors flee. The lesson: don't trust the dividend. Verify the fundamentals behind it. Tax drag, as mentioned earlier, is a silent return killer. Even with preferential tax rates, annual dividend taxation creates a compounding disadvantage versus growth stocks, where taxes are deferred until sale. Over 20 to 30 years, this difference can amount to tens or even hundreds of thousands of dollars in lost wealth, depending on the size of the portfolio and tax bracket. Investors in tax-advantaged accounts, like individual retirement accounts or 401ks, can mitigate this, but those holding dividend stocks in taxable accounts are accepting an unnecessary performance handicap. This doesn't mean you should avoid dividends. It means you should be intentional about where you hold them and ensure the pre-tax yield justifies the tax cost. Finally, the psychological trap. Dividend investors often fall in love with the ritual of income. They check their brokerage accounts for dividend deposits like clockwork, mistaking cash flow for performance. This creates emotional attachment that overrides rational analysis. They'll hold onto a deteriorating stock because it still pays, ignoring warning signs. They'll avoid selling even when valuation is extreme or fundamentals are crumbling. The dividend becomes a security blanket, comforting but potentially suffocating. The antidote is discipline. Treat dividends as part of total return, not a separate income stream. Reassess holdings annually based on business health, not payout consistency. The moment you prioritize the dividend over the company, you've stopped investing, you've started collecting. Growth stocks generate returns through capital appreciation driven by expanding revenue, earnings, market share, or technological dominance, not through cash distributions. The fundamental engine behind their performance is reinvestment. Instead of paying profits to shareholders, these companies plow every available dollar back into scaling operations, acquiring competitors, developing new products, or entering new markets. This creates a compounding effect. If each reinvested dollar generates more than $1 in future value, the stock price rises accordingly. The mistake most investors make is judging growth stocks by the same metrics used for dividend payers: price-to-earnings ratios, yield, payout consistency, when in reality the relevant metrics are revenue growth rate, gross margin expansion, customer lifetime value, and free cash flow conversion over time. The core misunderstanding lies in conflating no dividend with no return. Many investors, especially those conditioned by fixed income or dividend-focused strategies, perceive growth stocks as speculative because they don't provide immediate cash flow. But the absence of dividends is not a flaw, it's a deliberate capital allocation strategy. Companies like Amazon, Tesla, or Nvidia spent years without paying dividends, not because they were failing, but because they were building ecosystems, infrastructure, and competitive moats that would later generate exponential returns. The investor's job is not to demand income today, but to assess whether the company's reinvestment rate of return exceeds the cost of capital. If it does, withholding dividends is the optimal path to long-term wealth creation. Valuation anxiety is the most common emotional barrier to holding growth stocks. Investors see high price-to-earnings ratios, 50 times, 100 times, even 200 times, and assume the stock is overvalued. But traditional valuation metrics break down when applied to hypergrowth companies. A software-as-a-service business growing revenue 50% annually with 80% gross margins and negative customer churn may justify a 50-time sales multiple because its earnings power is still in the early stages of scaling. The key is not the static multiple, but the trajectory. If revenue doubles in 2 years and margins expand, today's expensive valuation becomes tomorrow's bargain. The market prices future cash flows, not past earnings. Investors who sell growth stocks because the price to earnings is too high often miss the most explosive phases of appreciation. Another critical misconception is that growth stocks are inherently more volatile and therefore riskier than dividend stocks. While it's true that growth stocks exhibit higher price volatility in the short term, volatility is not synonymous with risk. Risk is the permanent loss of capital, and growth stocks with durable competitive advantages, scalable unit economics, and strong balance sheets often carry lower long-term risk than dividend stocks in declining industries. A 6% yielding coal company is far riskier than a 0% yielding cloud infrastructure company with 30% annual growth and net dollar retention above 120%. Volatility is noise. Business model obsolescence is risk. Growth investors must learn to tolerate short-term price swings in exchange for structural, long-term advantage. Capital efficiency is the hidden metric that separates real growth companies from speculative hype. Not all revenue growth is valuable. If a company grows sales by burning cash on unprofitable customer acquisition or unsustainable discounts, it's destroying shareholder value, even if the top line is rising. The critical indicators are: 1. Gross margin. Does the product or service have pricing power? 2. Operating leverage. Do incremental revenues flow through to profits? 3. Free cash flow margin. Is the company converting revenue into cash? 4. Reinvestment rate. How much capital is required to sustain growth? Companies like Apple, Microsoft, and Shopify succeeded not just because they grew, but because they grew profitably and efficiently. Revenue without margin is vanity. Cash flow with scalability is sanity. Market leadership and network effects are often undervalued by traditional investors. Many growth companies operate in winner-take-most markets: social media, search engines, cloud platforms, digital payments, where scale creates self-reinforcing advantages. The first mover with the largest user base attracts more developers, more advertisers, more data, and more ecosystem partners, making it exponentially harder for competitors to catch up. This dynamic justifies premium valuations because the future cash flows are not linear, they're exponential. Investors who dismiss these companies as bubbles because they don't pay dividends are ignoring the economic reality of platform dominance. Owning a piece of a monopolistic or oligopolistic digital infrastructure is fundamentally different from owning a piece of a regulated utility. One has pricing power and infinite scalability. The other has regulatory caps and finite demand. Timing and patience are the invisible skills required to profit from growth stocks. Unlike dividend stocks, which provide regular psychological rewards, growth stocks demand long holding periods and tolerance for drawdowns. Many of the best-performing growth stocks experience 30%, 40%, or even 50% declines during their ascent. Not because the business failed, but because sentiment shifted, interest rates moved, or macro fears spiked. Investors who panic sell during these corrections forfeit the long-term compounding. The real return in growth investing comes from holding through volatility, not from timing entry and exit. This requires a fundamental understanding of the business, not just the stock price. If you don't know why the company will be larger and more profitable in 5 years, you shouldn't own it, regardless of recent performance. Dilution risk is rarely discussed but critically important. Some growth companies fund their expansion by issuing new shares, which dilutes existing shareholders. If the capital raised generates returns higher than the cost of dilution, it's accretive. If not, it's destructive. Investors must monitor share count trends. Is it stable, declining via buybacks, or rising? A company that issues 10% more shares annually to fund 15% revenue growth may still be creating value, but only if the incremental revenue is high margin and scalable. If the growth is low margin and requires perpetual dilution, the stock may never appreciate despite top-line expansion. Always ask, is growth funded by retained earnings, debt, or equity issuance? The answer determines whether you're building wealth or funding someone else's experiment. Tax efficiency is a structural advantage that most investors overlook. Because growth stocks don't distribute taxable income annually, all gains compound tax-deferred until sale. This creates a powerful tailwind over decades, especially in taxable accounts. A $10,000 investment growing at 15% annually for 20 years becomes $163,665. If that same return were taxed annually at 20%, as with dividends, the final value drops to approximately $93,000, a 43% reduction in wealth. This isn't theoretical, it's mathematical. Growth investing isn't just about higher returns. It's about higher after-tax returns. For investors in high tax brackets or long time horizons, this advantage alone can justify a heavy allocation to non-dividend paying equities, even if headline yields appear attractive elsewhere. Finally, the biggest myth is that growth stocks are only for young investors or aggressive portfolios. In reality, every investor needs exposure to innovation and structural growth, regardless of age. A 70-year-old retiree still has a 20-plus year horizon and needs assets that outpace inflation. A static portfolio of dividend payers in slow-growth industries may preserve capital nominally but destroy it in real terms. The solution isn't to avoid growth. It's to size the position appropriately and pair it with stabilizing assets. Even a 10 to 20% allocation to high-quality growth stocks can dramatically improve a portfolio's long-term return profile without adding unacceptable volatility. Growth isn't a phase, it's a necessity. Ignoring it because I need income is a failure of portfolio construction, not a virtue of conservatism. Dividend investing is often marketed as the safe, conservative, or income-generating path, but beneath the surface lie hidden costs, behavioral traps, and structural risks rarely disclosed by brokers, financial media, or even well-meaning advisors. The first and most insidious cost is tax inefficiency. In taxable accounts, dividends, even qualified ones taxed at lower rates, trigger annual tax liabilities. This creates a compounding drag. Each year, a portion of your return is siphoned off to the government, reducing the capital available for reinvestment. Over 20 to 30 years, this drag can consume 20 to 40% of potential wealth, depending on yield, tax bracket, and market returns. Growth stocks, by contrast, defer all taxation until sale, allowing 100% of returns to compound uninterrupted. This isn't a minor detail, it's a wealth-altering structural difference. The second hidden cost is reinvestment risk. When you receive a dividend, you now hold cash that must be redeployed. If markets are expensive, you're forced to buy overvalued assets or sit in low-yield cash, both of which reduce long-term returns. In contrast, growth stocks automatically reinvest profits at the company level, often at high internal rates of return. You don't have to time the market or make allocation decisions. The compounding happens organically. Dividend reinvestment plans help, but they still execute at market prices, which may be unfavorable. The illusion of passive income masks the active management burden you've unknowingly accepted. Now you must manage cash flows, rebalance, and redeploy, tasks most retail investors are neither trained for nor interested in performing. Sector concentration risk is another silent portfolio killer. Dividend-paying stocks are overwhelmingly concentrated in a handful of industries: utilities, real estate investment trusts, energy, financials, and consumer staples. These sectors share common vulnerabilities: sensitivity to interest rates, utilities, real estate investment trusts, commodity price swings, energy, regulatory risk, utilities, banks, and disruption from technology or consumer trends, staples, retail. By chasing yield, investors unknowingly build portfolios that are structurally exposed to macroeconomic and sector-specific shocks. A single rate hike cycle can crater your utility holdings. An oil glut can vaporize your energy dividends. A shift to e-commerce can erode your consumer staples. True diversification requires exposure to different economic drivers, not just different tickers within the same vulnerable sectors. Capital erosion disguised as income is perhaps the most dangerous illusion. Many investors hold stocks solely because they pay a dividend, ignoring that the underlying business may be shrinking. A company can maintain or even increase its dividend while cutting research and development, deferring maintenance, taking on debt, or selling assets, all of which destroy long-term value. The dividend becomes a withdrawal from principal, not a return on capital. When the dividend is finally cut, often after years of deterioration, the stock typically collapses, and investors suffer both income loss and capital loss simultaneously. The warning signs are always there: declining revenue, shrinking margins, rising debt, falling free cash flow. But dividend investors often ignore them, seduced by the ritual of quarterly checks. Management misalignment is a subtle but critical risk. When executives are incentivized to maintain or grow dividends, often to attract income investors or meet analyst expectations, they may prioritize payout consistency over strategic reinvestment. This can lead to underinvestment in innovation, outdated technology, or bloated cost structures, all of which undermine competitiveness. Some companies even borrow money or issue shares to fund dividends, a clear sign of unsustainability. The market may reward this behavior in the short term. Yield-chasing demand pushes the stock up, but eventually, fundamentals catch up. The dividend isn't a sign of strength. It's often a mask for weakness. Inflation risk is systematically underestimated. A safe 4% dividend yield sounds attractive, until you realize inflation is running at 3 to 6%. If the dividend doesn't grow faster than inflation, your real purchasing power declines every year. Most dividend stocks, especially in regulated or mature industries, struggle to grow payouts at inflation-beating rates over long periods. Utilities, for example, are often capped by regulators. Telecoms face saturation. Energy firms are tied to volatile commodity prices. Meanwhile, growth companies with pricing power, software platforms, brands, can raise prices and grow earnings at 10 to 20% annually, easily outpacing inflation. Income without growth is a slow path to irrelevance. Opportunity cost is the silent thief of returns. Capital allocated to low growth, high dividend stocks is capital not allocated to innovation, disruption, or exponential technologies. While your portfolio collects 3 to 4% in dividends, the broader market or a concentrated growth portfolio may be compounding at 12 to 15%. Over 10 years, that difference can mean hundreds of thousands of dollars in lost wealth. This isn't hypothetical, it's arithmetic. From 2010 to 2020, the S&P 500 dividend aristocrats returned approximately 10% annually. The Nasdaq 100 returned approximately 18%. The difference on a $100,000 investment, $159,000 versus $523,000. Yield feels safe, but stagnation is the real risk. Behavioral traps compound all these risks. Dividend investors often develop emotional attachments to their holdings. I've held this stock for 20 years. It's never missed a dividend. This loyalty overrides rational analysis. They ignore deteriorating fundamentals, sector disruption, or extreme valuations because the dividend is safe. They avoid selling even when the business model is obsolete. The dividend becomes a psychological security blanket, comforting but potentially lethal. In contrast, growth investors are forced to constantly reevaluate. Is this company still growing? Is the competitive advantage intact? Is the valuation still justified? This active scrutiny, while uncomfortable, often leads to better long-term outcomes. Liquidity illusion is another hidden danger. Many investors believe dividend stocks are liquid income, but in reality, selling shares to generate cash is often more tax-efficient and flexible than relying on fixed quarterly payouts. With dividend stocks, you're locked into the company's payout schedule and amount. With growth stocks, you control when and how much to withdraw by selling shares, and you can do so strategically, e.g. in down markets at loss to offset gains or in low-income years. Dividends force taxable events on the issuer's timeline. Share sales allow tax management on your timeline. Flexibility beats rigidity, especially in retirement. Finally, the myth of downside protection. Dividend stocks are often sold as safer during market downturns, but history shows this is false. In the 2008 financial crisis, financial dividend stocks collapsed. In 2020, energy and retail dividend stocks imploded. In 2022, rate-sensitive real estate investment trusts and utilities got crushed. Dividends offer no protection against fundamental business risk or sector collapse. In fact, high-yield stocks often fall harder when their payouts are questioned, triggering panic selling. True downside protection comes from diversification, quality, and valuation, not dividend policy. The belief that dividends cushion losses is marketing, not math. Risk is defined by business durability, not by whether a company mails you a check every quarter. Growth investing is often misunderstood as speculative, volatile, or suitable only for aggressive traders. But in reality, it offers structural advantages that, when paired with discipline, can generate superior long-term returns with lower true risk than dividend-focused strategies. The first and most powerful advantage is tax-deferred compounding. Because growth stocks do not distribute taxable income annually, all gains, whether from earnings growth, margin expansion, or multiple expansion, compound without annual tax leakage. This creates a snowball effect. A $100,000 investment growing at 12% annually for 30 years becomes $2,990,000. If that same return were taxed annually at 25%, the final value drops to $1,150,000. A 61% reduction in wealth. This isn't theory, it's the mathematics of compounding under taxation. For investors in taxable accounts, this single factor can justify a heavy tilt toward growth, even if headline yields appear attractive elsewhere. The second major advantage is capital allocation efficiency at scale. Growth companies reinvest profits at the corporate level, often at very high internal rates of return, 20%, 30%, even 50% plus. This is far more efficient than distributing cash to shareholders, who then must find equally high return opportunities to reinvest it. Most retail investors lack the skill, time, or access to replicate these returns. By retaining earnings, companies like Amazon, Alphabet, or Shopify compound value automatically, without requiring shareholders to make active reinvestment decisions. This eliminates reinvestment risk, timing risk, and behavioral errors. The company's management, ideally, is better equipped to allocate capital than the average investor. Trusting that process, when justified by track record, is not passive, it's intelligent delegation. Inflation-beating power is another critical advantage. Growth companies, particularly those with pricing power, network effects, or subscription models, can raise prices, expand margins, and grow earnings at rates that far exceed inflation. A software-as-a-service company with 90% gross margins can increase prices 5 to 10% annually with minimal customer loss. A consumer brand with cult loyalty can pass through cost increases effortlessly. A platform business with zero marginal cost can scale revenue without proportional cost increases. Meanwhile, most dividend stocks, utilities, real estate investment trusts, industrials, are constrained by regulation, competition, or input costs. Their ability to grow earnings, and therefore dividends, at inflation-beating rates is limited. Over decades, this difference in real purchasing power growth is enormous. Exposure to innovation and structural trends is not a luxury, it's a necessity. The global economy is being reshaped by artificial intelligence, automation, electrification, biotech, and digital transformation. Companies leading these trends, NVIDIA, Tesla, Moderna, ASML, are not dividend payers. They are growth engines. Investors who avoid them because they don't pay dividends are opting out of the most powerful wealth creation opportunities of our era. This isn't speculation. It's participation in economic evolution. Even conservative portfolios need exposure to these forces, not for speculation, but for preservation of real purchasing power. A portfolio of 1950s-era dividend stocks would have missed the entire tech revolution. Don't repeat that mistake. Valuation flexibility is a hidden benefit. Growth investors are not locked into yield targets or payout ratios. They can buy companies at various stages, early hypergrowth, mid-stage scaling, or late-stage maturity, and still generate strong returns if the business execution is sound. A company growing 50% annually may trade at 20 times sales today, but if it grows into 5 times sales with 30% margins in 5 years, the return will be extraordinary. Dividend investors, by contrast, are often forced to chase yield in overvalued or deteriorating sectors simply to meet income needs, locking them into value traps. Growth investing allows you to buy quality at fair prices, not desperation yields at dangerous valuations. Behavioral discipline is the non-negotiable requirement. Growth investing demands patience, emotional control, and deep fundamental understanding. Unlike dividend stocks, which provide regular psychological rewards, quarterly checks, growth stocks require you to sit through volatility, drawdowns, and periods of underperformance, often for years, while the business scales. This is not for everyone. It requires conviction in the business model, trust in management, and acceptance of short-term noise. But this very difficulty creates an edge. Most investors can't do it. They panic sell during corrections, chase performance at peaks, or abandon positions too early. Those who master the discipline, holding through 30 to 50% drawdowns, ignoring macro noise, focusing on unit economics, capture the full power of compounding. Avoiding yield traps is another silent benefit. Growth investors are immune to the siren song of high-yield stocks masking deteriorating businesses. They don't get seduced by a 7% payout from a dying mall real estate investment trust or a leveraged energy company. They focus on cash flow generation, margin expansion, and return on invested capital metrics that reveal true business health. This avoids the catastrophic losses that often follow dividend cuts, when both income and principal vanish simultaneously. Growth investors may experience price volatility, but they rarely suffer permanent capital impairment, provided they invest in companies with durable advantages and scalable economics. Global opportunity set is wider and deeper. The most innovative, high-growth companies are not confined to dividend-heavy markets like the United States or Europe. They're in Taiwan, TSMC, South Korea, Samsung, China, despite recent challenges, Israel, and emerging tech hubs worldwide. Many of these companies don't pay dividends, they reinvest aggressively. By focusing only on dividend payers, investors artificially limit their universe to slower growth, mature market companies. Growth investors access the full global innovation economy, not just the income-generating slice of it. This diversification across geographies, sectors, and innovation cycles is a powerful risk mitigator. Control over cash flow timing is a strategic advantage rarely discussed. With growth stocks, you decide when to create income by selling shares, and you can do so strategically. In low-income years, after losses to offset gains, or during market highs. With dividend stocks, you receive income on the company's schedule, whether you need it or not, triggering taxable events regardless of your personal tax situation. This flexibility is especially valuable in retirement, where managing taxable income is critical for Medicare premiums, tax brackets, and Social Security taxation. Growth investing puts you in control. Dividend investing outsources that control to corporate boards. Finally, the alignment with long-term economic reality. The global economy is not becoming slower, more regulated, or more yield-dependent. It's becoming faster, more innovative, and more driven by technology, data, and intellectual property. Companies that thrive in this environment are not capital-intensive utilities or commodity producers. They're asset-light, scalable, high-margin platforms and ecosystems. Investing solely in dividend payers is a bet against this trend, a bet that the future will look like the past. Growth investing is not speculative, it's adaptive. It's not risky, it's realistic. The real risk is not participating in the engines of future wealth creation and pretending that a 4% yield from a declining business is safe. Chasing dividend yield is the single biggest mistake dividend investors make, and it's the reason so many end up holding value traps, deteriorating businesses, or companies on the brink of a payout cut. To invest intelligently in dividend stocks, you must ignore the headline yield and focus on the underlying business health, sustainability, and growth potential. The first and most critical metric is free cash flow payout ratio, not earnings payout ratio. Earnings, net income, can be manipulated through accounting. Free cash flow, operating cash flow minus capital expenditures, is real, spendable cash. If a company pays out 75% of its free cash flow as dividends, it has a 25% buffer for downturns, reinvestment, or debt reduction. If it pays out 120%, it's borrowing or issuing shares to fund the dividend, a clear red flag. Always demand free cash flow coverage of at least 1.2 times, preferably 1.5 times or higher. The second essential metric is dividend growth rate over 5 to 10 years. A static dividend in an inflationary world is a declining real return. The best dividend stocks don't just pay. They grow their payouts consistently, ideally at a rate exceeding inflation, 3 to 5% plus annually. Companies with 10 plus years of consecutive dividend increases, dividend aristocrats, have demonstrated both financial discipline and business resilience. But don't just count the streak, analyze the growth rate. A company increasing its dividend by 2% annually is barely keeping pace with inflation. One growing at 7 to 10% is compounding your income meaningfully. Prioritize growth trajectory over static yield. Balance sheet strength is non-negotiable. A company can have strong cash flow today but be buried under debt that will eventually force a dividend cut. Key metrics. Net debt divided by EBITDA should be less than 3 times for most sectors, less than 5 times for real estate investment trusts and utilities. Interest coverage ratio, EBIT divided by interest expense, should be greater than 4 times, and debt divided by equity should be less than 1.0 for most industries. High leverage magnifies risk, especially in rising rate environments. Many high-yield dividend stocks, especially in energy, telecom, and real estate investment trusts, carry dangerous debt loads that become unsustainable when rates rise or cash flows decline. A 7% yield means nothing if the company files for bankruptcy in 18 months. Revenue and earnings trends must be analyzed, not just dividend history. A company can maintain its dividend while shrinking its top line by cutting costs, selling assets, or taking on debt. This is unsustainable. Look for at least stable, preferably growing, revenue and earnings per share over 3 to 5 years. Declining revenue with flat dividends is a warning sign. Also examine gross margins and operating margins. Are they stable or expanding? Margin contraction often precedes earnings collapse and dividend cuts. Don't just look at the payout, look at the engine generating it. Sector and industry dynamics are crucial context. Some industries are structurally declining: print media, traditional retail, fossil fuels, and no amount of dividend history can overcome secular headwinds. Others are stable but regulated: utilities, telecom, where growth is capped and dividends are the primary return driver. Know what you're buying. A company in a sunset industry paying you to exit slowly, or a company in a stable industry with pricing power and modest growth. Adjust your expectations and valuation accordingly. A 5% yield from a utility is not equivalent to a 5% yield from a department store chain. One has regulatory protection. The other has Amazon as a competitor. Return on equity, ROE, and return on invested capital, ROIC, reveal capital efficiency. A company paying dividends should still be generating strong returns on the capital it retains. ROE greater than 12% and ROIC greater than 10% are good benchmarks. If these metrics are declining, it signals deteriorating business quality, even if the dividend is safe today. High returns on capital indicate pricing power, competitive advantage, and efficient operations, all of which support long-term dividend sustainability. Low or falling returns suggest the business is struggling, and the dividend is at risk. Share count trend is a silent indicator. Is the company buying back shares, reducing share count, or issuing new shares, increasing share count? Buybacks are accretive. They increase earnings per share and free cash flow per share, supporting dividend growth. Share issuance is dilutive. It spreads earnings and cash flow over more shares, making dividend growth harder. Many high-yield companies issue shares to fund dividends or acquisitions, a dangerous sign. Prefer companies with stable or declining share counts. It shows they generate enough internal cash to fund operations and payouts without diluting owners. Management capital allocation philosophy matters more than most investors admit. Read annual reports and earnings calls. Does management prioritize dividend growth, buybacks, debt reduction, or reinvestment? Are they candid about challenges? Do they have a clear long-term strategy? Companies that treat dividends as sacred, even at the expense of balance sheet health or innovation, are dangerous. Companies that grow dividends responsibly, while also investing in the future, are keepers. Culture and incentives drive behavior, and behavior determines dividend sustainability. Valuation relative to growth, not just yield. A 4% yield sounds attractive, until you realize the company's earnings are shrinking 3% annually. In that case, you're being paid to lose money. Use metrics like PEG ratio, Price to earnings divided by earnings growth rate. A PEG less than 1.0 suggests undervaluation. Also consider enterprise value divided by EBITDA and free cash flow yield. Free cash flow divided by market cap. A 5% free cash flow yield with 5% dividend growth is far more attractive than a 7% dividend yield with 0% free cash flow yield and declining cash flow. Yield is a snapshot, valuation relative to growth is the movie. Finally, stress test the dividend. Ask, could this company maintain its dividend if revenue fell 10%? If interest rates rose 2%? If a key customer left? Model downside scenarios. Look at how the company performed during past recessions or sector downturns. Did it cut the dividend? Raise it? Hold it? History doesn't repeat, but it rhymes. Companies that maintained or grew dividends through 2008, 2020, or 2022 are likely more resilient than those that didn't. Don't just buy the yield, buy the resilience behind it. A dividend is only as strong as the business funding it. Growth stocks are often dismissed as speculative, overvalued, or driven by hype. But the reality is that the best growth companies are analyzable, quantifiable, and predictable using the right metrics. The key is to ignore headline growth rates and price-to-earnings ratios and focus on the underlying unit economics, scalability, and capital efficiency that drive sustainable, profitable expansion. The first and most critical metric is revenue growth rate, but only when paired with gross margin. A company growing revenue 50% annually with 20% gross margins is burning cash to buy growth, likely unsustainable. A company growing 30% with 80% gross margins is building a scalable, high-margin business. Gross margin reveals pricing power and product differentiation, the foundation of durable growth. Never evaluate growth in isolation. Always ask, at what margin? The second essential metric is net dollar retention, NDR, or revenue retention rate, especially for software as a service and subscription businesses. NDR measures how much revenue expands or contracts from existing customers over time. An NDR above 100% means customers are spending more each year through upsells, cross-sells, or price increases, even without new customer acquisition. This is the holy grail of scalable growth. A company with 120% NDR can grow revenue even if it stops acquiring new customers, because its existing base is expanding. This reduces customer acquisition costs, increases lifetime value, and creates a self-reinforcing flywheel. Prioritize companies with NDR greater than 110%. They're building ecosystems, not just selling products. Free cash flow margin and conversion separate capital-efficient growers from cash-burning pretenders. Revenue growth is vanity. Cash flow growth is sanity. Calculate free cash flow margin, free cash flow divided by revenue, and free cash flow conversion, free cash flow divided by net income. High-growth companies may have negative free cash flow early on, but the trend should be toward positive and expanding margins. Ideally, free cash flow margin should be greater than 10% for mature growers, and free cash flow conversion greater than 80%. If a company grows revenue but free cash flow margins are shrinking or negative indefinitely, it's not a business, it's a charity. Real growth compounds cash, not just top line. Customer acquisition cost, CAC, payback period, reveals efficiency. How many months of gross profit does it take to recover the cost of acquiring a customer? Under 12 months is excellent. 12 to 18 is acceptable. Over 24 is dangerous. A long payback means the company is funding growth with external capital, which becomes unsustainable if funding dries up. Pair this with customer lifetime value, LTV, divided by CAC ratio, should be greater than 3 times. If LTV divided by CAC is less than 1.5 times, the company is destroying value with every new customer. These metrics expose whether growth is profitable or parasitic. Operating leverage is the silent accelerator. As revenue grows, do operating margins expand? This happens when fixed costs, research and development, general and administrative, are spread over a larger revenue base. A software-as-a-service company with 70% gross margins should see operating margins expand from negative 10% to positive 20% as it scales, without increasing headcount proportionally. This is the magic of scalable software. Monitor operating margin trends quarter over quarter. Expansion is a sign of healthy scaling. Contraction is a red flag. Balance sheet strength and cash runway are critical for pre-profitability growers. How many years of operating expenses can the company fund with current cash and equivalents? Less than 18 months is risky. 24+ months is comfortable. Also examine burn rate, quarterly cash outflow, and whether it's declining as a percentage of revenue. A company reducing its burn rate while growing revenue is on the path to profitability. One increasing burn to fund growth is playing with fire, especially in tight funding environments. Market share and competitive positioning matter more than size. A company growing 20% in a stagnant market is gaining share, a sign of competitive strength. One growing 50% in a hyper-competitive, red ocean market may be buying growth with discounts, unsustainable. Analyze the competitive landscape. Is the company a leader, challenger, or niche player? Does it have network effects, intellectual property moats, or switching costs? Growth without defensibility is temporary. Management's capital allocation track record is decisive. Do they reinvest at high rates of return? Do they avoid dilutive acquisitions? Do they prioritize profitability over vanity metrics? Read shareholder letters and earnings transcripts. The best growth chief executive officers are obsessed with unit economics, not just top line. They delay gratification, reinvesting today to dominate tomorrow. Avoid companies where management chases growth at all costs without a path to margins. Valuation relative to growth efficiency, not absolute multiples. Use metrics like price divided by sales, but only if paired with gross margin and growth rate. A better metric is enterprise value divided by forward gross profit for hypergrowers. Or Rule of 40. Revenue growth percent plus free cash flow margin percent greater than 40. A company growing 30% with 15% free cash flow margin equals 45. Passes. One growing 50% with negative 20% free cash flow margin equals 30. Fails. This filters out unprofitable hype. Finally, stress test the growth. Ask, what if growth slows to 20%? What if CAC doubles? What if a competitor underprices by 10%? Model downside scenarios. The strongest growth companies have optionality. Multiple paths to monetization, geographic expansion, or product adjacencies. The weakest are one-trick ponies. Invest in growers with optionality, not just momentum. Growth is not a lottery, it's a math problem. Solve it with metrics, not memes. The ultimate truth most investors never learn is this. You don't have to choose between dividend stocks and growth stocks. The most rational, resilient, and high-performing portfolios combine both, strategically, intentionally, and in proportions aligned with your goals, time horizon, and risk capacity. The first step is to define your objective. Are you accumulating wealth? Growth focus? Preserving capital while generating income? Dividend focus? Or both? A 30-year-old saving for retirement needs 80 to 90% in growth assets to maximize compounding. A 70-year-old funding living expenses may need 50 to 60% in dividend payers for predictable cash flow. Neither is wrong, but misalignment is catastrophic. Start with purpose, not yield or price to earnings. The second principle is asset location, not just allocation. Hold dividend stocks in tax-advantaged accounts, individual retirement accounts, 401ks, to avoid annual tax drag. Hold growth stocks in taxable accounts to benefit from tax-deferred compounding and lower long-term capital gains rates. This simple structural decision can add 1 to 2% annually to after-tax returns over decades. Never let tax inefficiency erode your strategy. Design around it. Core satellite framework works best. Use dividend stocks as the core, 40 to 60% of portfolio, for stability, lower volatility, and income generation. Focus on high-quality, low-debt, dividend-growing companies in resilient sectors, healthcare. Select consumer staples, infrastructure. Use growth stocks as the satellite, 30 to 50%, for capital appreciation, inflation-beating returns, and exposure to innovation. Focus on companies with durable advantages, scalable economics, and strong balance sheets. The remaining 10 to 20% can be in cash, bonds, or alternatives for liquidity and risk management. Rebalancing discipline is non-negotiable. Growth stocks will outperform in bull markets, pushing your allocation beyond targets. Dividend stocks may outperform in bear markets or high inflation regimes. Rebalance annually, sell a portion of outperformers by underperformers to maintain target weights. This forces you to buy low, sell high systematically. It also prevents emotional decisions, like abandoning growth after a crash or chasing dividend yield at market peaks. Income generation doesn't require dividends. Retirees often believe they need dividend stocks for cash flow, but this is a myth. You can generate income more efficiently by selling shares of growth stocks, strategically in low-income years at loss to offset gains or during market highs. This gives you control over timing, amount, and tax treatment. A 3% withdrawal rate from a $1 million growth portfolio generates $30,000, same as a 3% dividend yield, but with greater flexibility and potentially higher after-tax returns. Don't confuse income mechanism with income sufficiency. Avoid yield chasing and growth chasing extremes. The biggest portfolio killers are behavioral, buying high-yield stocks after they've outperformed and are overvalued, or piling into growth stocks at bubble valuations. Both lead to buying high and selling low. Stick to valuation discipline. Buy dividend stocks when free cash flow yield is attractive and payout ratios are safe. Buy growth stocks when revenue growth, margins, and efficiency metrics justify the multiple. Ignore macro noise, focus on micro fundamentals. Diversify across economic drivers, not just sectors. Your dividend sleeve should include exposure to healthcare, demographic resilience, infrastructure, regulatory stability, and global staples, pricing power. Your growth sleeve should include exposure to artificial intelligence, automation, biotech, and digital infrastructure, not just United States tech. This reduces concentration risk and captures global innovation. Monitor and evolve. Your allocation at 40 should not be your allocation at 70. Gradually shift from growth to income as you approach and enter retirement, but never eliminate growth entirely. Even at 80, you need assets that outpace inflation. A 20 to 30% allocation to high-quality growth stocks can preserve real purchasing power for decades. Review your portfolio annually, not for performance but for alignment with life stage, goals, and economic reality. Ignore dogma. There is no moral superiority in dividends or growth. There is only math, total return after tax, after inflation, over your time horizon. The best portfolio is the one that lets you sleep at night while achieving your goals. If you panic sell growth stocks in every correction, you shouldn't own them, no matter how attractive the long-term math. If you ignore deteriorating fundamentals because the dividend is safe, you shouldn't own dividend stocks. Honesty about your behavior is more important than theoretical optimization. Finally, the call to action. If this breakdown helped you see dividend and growth investing in a new light, beyond the myths, marketing, and emotional traps, then you're ready to build a smarter, more rational portfolio. Don't just watch, act. Reassess your holdings. Check your metrics. Align your allocation with your goals, not your biases. And if you found this valuable, do 3 things right now. 1. Like this video. It helps others find this truth. 2. Subscribe. Because next week, we're breaking down how to build your personalized allocation model step by step. 3. Comment below. Tell me, dividends or growth? And I'll reply with a custom tip based on your answer. The truth is out there. Stop guessing. Start building.